topic of this PPT is accounting rate of return. And as we all know, that accounting rate of return is one of the capital budgeting techniques that's used by the companies to decide to make a decision on the project that they undertake. Now, accounting rate of return is also known as return on investment, because if you see, it is primarily the return calculated on the investment that you make on a project, which will become clear to you when you look at the formula. The formula is given as average annual profit after tax divided by initial investment. Okay, and which is when multiplied by 100 gives the percentage, the ARR in the form of percentage. Now, the average annual profit after taxes, total revenues minus total expenses. Please remember that this is profit after tax. So when you are doing the numericals, sometimes the numericals may be confusing and they may give you a profit before tax. So you'll have to ensure that you calculate the profit after tax, and then divide it by the number of years to get the annual profit in case the annual numbers are not given to you. And initial investment, that's also the average investment. So basically the numerator and the denominator, both of them are the averages. It will become more clear to you if you look at the example here. Now the example says that XYZ Limited is planning to buy a new production equipment which costs $240,000. So this is the initial investment that XYZ Limited is planning to make, but the company has unequal net cash flows during its life. So with the employment of this investment, the company will have the cash flows as shown in the Excel here, from year 1 to year 6, 1 lakh dollars, 80,000, 50,000, and so on. And $30,000 is the residual value at the end of its life, which means the residual value of the production equipment. After 6 years, the life of the equipment gets over, and the residual value of that equipment is $30,000. Calculate the accounting rate of return. So all the relevant information is given to you. While for calculating the ARR, you will have to first start with calculating if you look at the formula here, it says average annual profit after tax. So we will calculate the average annual profit. Let's see how we do it. Well, this is an Excel sheet which describes the process to you in detail. So from the first year till the 6th year, the total annual cash flow is $360,000. We have added up all of them because these are uneven. So the average, so to find out the average, it's essential to add up all of them. $360,000 across 6 years. So the average is 360,000 divided by 6, which gives you $60,000 of annual cash inflows. That's not the profit, that's only the cash inflows. Now, for you to find out the profit, you will have to deduct expenses out of it, as is shown in the slide here. Profit is total revenue minus total expense. So what you have just now got is the total revenue. From that, since the question does not specify any other expenses apart from depreciation expenses, we will deduct depreciation expenses from 60,000. How do you calculate depreciation expenses? The machinery costs you. I hope you all know what is depreciation. So the machinery costs the company $240,000. And the residual value of the machinery is 30,000, which means the machinery, after the life of the machinery, you will still have 30,000. You will get 30,000 out of that machinery. So all in all, the expense on the machinery is 2,10,000. So 2,10,000 divided by 6 years will give you depreciation year on year, which is $35,000 is the depreciation year on year. So yearly cash inflow is 60,000, yearly cash expense is 35,000. Hence, the annual income is 60,000 minus 35,000, which is 25,000. So the annual income is given to you. The annual investment was given to you, which was 2,40,000 initial investment, and then when you divide the annual income by the initial investment and multiply it by 100, you get the ARR, which is 10.4166, which can be approximated to 10.42. That is how you calculate the ARR. Well, I hope this example makes it clear to you. We will discuss about the next capital budgeting technique in the next set of slides. Thank you.